Hey everybody, this is Paul doing a dividend video, portfolio update, my bi-weekly update. It's not the 15th quite, but the 15th on a Saturday, so figure I might as well knock this out today since we have, I think, all the information we kind of need to get a general idea of what the market's doing, where I think it's going, that kind of thing. So let's kind of look over this, see where we're at, see what's going on. So, as expected, when the big banks reported their earnings, the GSIBs, global systemic banks, when they reported their earnings, well, no shock. All of a sudden, they saw just this massive influx of cash from somewhere. Well, we all know where that cash came from. So it came from the regional banks, and pretty much people pulling their money like there's no tomorrow. And you can see that right there. So why isn't the market up? Well, very simple, and you can kind of see right here. So here's one of them. This is the big one that everybody's waiting to report, and I believe they report. I thought they should have reported by now. I don't know. It's kind of weird, but yeah, this they're kind. Everybody's kind of waiting for the regional banks to report because they have different things that are affecting their balance sheets than the big guys. So you can kind of see what's going on with the big guys: Citigroup, J.P. Morgan, Bank of America. So what's going on with the market exactly? Well, the inflation data came in and it wasn't that bad. It actually came down by a significant amount, um, running 4% inflation year over year, I believe. Where are we at here? I believe I have a copy of it. But, the inflation data is coming down. So, why is the market like what's going on with the market here and why did it wait until this all happened? Well, we've kind of been here before, so I can kind of show you this screenshot here to show you why, like we've been here before in history. And this is a screenshot or not a screenshot, but it's from the Federal Reserve Board. It was in a San Francisco newspaper that somebody found, and you can kind of get the general idea. So the dotted line right here, as the Federal Reserve was raising rates, you can see bank savings were going down at a very similar rate. This is the thrift savings. We used to have those. And as you can kind of see, and this is as the recession started, checking account balances started going up. But as you can see, money piled into money market funds. Now, why is money piling into money market funds? Well, very simple. It's the same reason I'm piling money into market funds. 4.75 yield with almost risk free. The only way that this would not be risk free is if the Federal Reserve defaulted, which would be a problem. It would be a bigger problem than anything the market's ever seen. So the problem has been is that the market has been pricing in effectively a bank crisis. That's why this has been sitting below 4% almost, basically. This has been sitting below 4%, expecting a hike and an immediate rate cuts. Well, the problem is that you might not get that bank crisis. And the reason why, and what the market's really reacting to, so you got bank earnings today, but the reason why is this is the bank funding program. These numbers just came out yesterday. You can see the amount that the banks are having to go to the Fed to basically loan them their assets is going down. So, and in foreign repo, if this was a bank crisis, this would be headed the opposite direction. There would be more stress on the banks. There would be more things that are making the banks crack. Now, we've seen similar things like this before where it goes down and then it immediately goes back up when the hammer drops. I believe that's going to be in commercial real estate as those loans just keep rolling over at higher and higher cost. And you're going to start to see more and more real estate get listed on the market. Can't miss it. Around in Louisiana, you see corporate real estate literally everywhere. Um, So why aren't we in a recession right now? Very simple. This is actually a wonderful graph that Bloomberg released, and this is what inflation is across the United States. Some people are feeling it more than others, and you can clearly see there's a little scale right here. If you're out west, you're feeling that inflation really hard because the inflation has mostly been in energy and housing costs. And what's the most expensive state to live in? California, that kind of thing. Texas, that kind of thing. So it's the places where they don't have a lot of refineries. So you're going to get a lot of energy inflation mixed in there too, but it affects the national numbers. And then if you want the lowest inflation numbers up here, and then if you want the, just a medium, look here. So it's very segmented on how the inflation is affecting just kind of the U.S., as you can kind of see. So where are we at in this process, and what's the market doing right now? So when you have the numbers yesterday that show that the Federal Reserve window is being used less, and then you also have the numbers coming out from the banks today basically saying, hey, look, not everything's as bad as you thought it was going to be. Well, this is exactly, and then you can kind of see CNBC right here. Big beats for major banks. That's not a financial crisis. That's not the banks seizing up. So what happened yesterday was something very, very interesting that a lot of people put a big bet that we were going to get a financial crisis like this month. So you can kind of see a lot of people very, very much piled into the very, very short end of the curve. This right here is like red flag central that something was about to break. Like just this massive move into the 1 month while the rest of the bond rates did nothing was kind of a hint that somebody out there was making a big bet that something was going to break or something was going to happen, and it didn't happen. So you can see what's going on with yields today. And this is what I expected because I keep asking everybody. I'm like, the Federal Reserve has rates set at 5%, 2 year, but the 2 year is sitting at 4.1%. This entire rally has been based on this coming down, that right there, and across the entire curve. But you can kind of see, it has been really based on all of this coming down. Now, what happens is if that reverses because we get better news, you don't get the recession. Um, I still think this market, like the banks, are still in trouble. Um, I don't think there's any doubting that. Everything just seems kind of slower out there right now. I don't know. We got to kind of see how the April data comes in. But I think April is going to be kind of like the start of there's it's just something. It just feels slower out there. I'm not sure how to describe it. Just doing DoorDash and that kind of stuff. You can kind of see that zones are a little deader than they normally are, even though there's more drivers. But they shouldn't be this dead. Um, so the market is reacting to the bond market. That's effectively what's going on right now. And the banks are celebrating because rates go higher. People are piling into them, but the problem is more people are piling into the big banks, leaving the little guys out to dry. And that's a problem because the little guys are how most businesses in this country get their funding. And that's going to be a big problem. So if these guys keep taking losses like this, so we're still waiting on numbers out of like a lot of the regional banks, and then we're going to get corporate earnings too that are going to give us a very big heads up on kind of where we're headed. Right now, big banks are celebrating. They're seeing all these deposits come in, all these new accounts, and all these people looking to get with systemic banks while the little banks are getting hit. So that's kind of where we're at right now. So where's the portfolio at? What have I been up to with the portfolio? So I'm glad I took this screenshot right here, or else I wouldn't have remembered. This is right around the last time I took a video. I had 2,350 in here. This says April 6th. So I've had the dividend reinvestments going on. I've put also just put another 55 in here. So this will be up to almost 2,595 here pretty soon. And then, so that's where most of my money's been going for the moment. It's updated on my spreadsheet here, as you can see. Risk-free, 4.75% yield. And it's going up every day. This is going as because this is a short-term fund, so you can kind of see. But every day, pretty much every time I click on this, this goes up. So eventually, this is going to say 5%. It's just eventually going to happen, um, which, as you can see, beats out majority of everything that I own that has exposure to the market. So you can kind of get the general idea here. I did buy one share of O yesterday. Just hadn't bought up one in a while. And I think I bought one share of SPHD, but a majority of most of the money I make has been getting piled into here. Just every week, just try to pile 50, or every day or so, to be honest with you, 50, 50, 65, whatever I get from DoorDash, just throw it in there and then just build up those funds. And then I did do a slight bit of rebalancing, nothing fancy here. I noticed that BIL, this one right here, was above 3%. It was like almost 4%. I'm trying to keep this around 3%. So I took some out of here and then redistributed it over here, as you can see, into these the different tech funds and whatnot. So when they do cut rates, you have a general idea what's going to rally. So that's the good news about this whole episode, is that you can kind of get the general idea of what's going to rally. So oddly enough, it's been Bitcoin. That's been hilarious, but that's just a sign that there's easier liquidity, lower rates, so people pile into these types of things. Um, Tech, obviously. Um, but here's one thing that's going on, and everybody's expecting this to break down here pretty soon, unless there's just some massive share back coming. Apple's trading at a 27 forward earnings. I don't know anybody who thinks that's gonna stay. Like, I don't know anybody who's possibly in their right mind thinks that's gonna keep going on. We'll know by the next time I do a video how that turned out, but like, you can get the general idea. But the rally that we're seeing has been mostly in the same stocks, the really big ones that take up a majority of this market. Um, so it could be just a lot of people taking profits. This could reverse later on the day. I somehow doubt it, but because you can kind of get the general idea is that eventually this market is going to have to price in the reality that the Federal Reserve is not going to cut this year. I just don't see it. Um, Unless the regional banks come out with something very, very bad, that they're just, they're keeping secret right now that we just don't know about. But you can get the general idea how this works. We've seen this game before. The Fed raises rates a whole bunch. People pile into money market funds, as you can see right here. I wish this little graph went on further so that you can kind of see what happened. Because I guarantee you, as the economy recovered after 1981, this number came down. It obviously had to have come down, but you can get the general idea. So we've seen this before. We know how it goes. Some banks aren't going to make it. We're just not at that point right now where we get the general idea, because you can kind of get the general idea of how this works. And this is just a typical graph of what happens when the Federal Reserve first cuts. And this is just throughout history. This is just research, whatever. But you can get the general idea of how the market acts after the first cut. So, and then you can kind of get the general, EPS. So we're waiting on earnings. So what happens is once the Federal Reserve, like, this is where I think we're at, the credit tightens part. You can get an idea here. This says it's an average length of maybe about 3 months. It's probably going to be longer. It's probably going to be longer. But I believe we're in this area right here, somewhere in here. But I don't know when we're getting this part right here. This first Fed cut, I don't know. The regional banks would have to come out and say, basically, we're falling apart here, guys. We need help. And then the Fed might say, well, we'll keep rates high, but we'll bail out your bad assets. I don't know what the market would do then. Because then the regional banks would be bailed out, but then, they would still be having higher rates. So we have to kind of see how that goes. But I think that's where we're at right now. So that's where I'm going to leave the video. Post your thoughts in the comments or anything like that. But like I said, we're kind of just, it's the waiting game. It's the same waiting game we've been doing for a few months now, waiting on inflation to come down and waiting for the Federal Reserve to start announcing those cuts, or pause something. So we'll know that by May, but not by the time I get my next video, we'll have much more clarity. Alrighty, well, thank you so much, guys. Y'all have a nice day.